You know what is interesting? Most people think passive income means either becoming a landlord or hoping companies keep paying dividends. But here's actually a third way that most people have never heard of. I'm Khalid Shamim and I've been working in wealth management for over 15 years. Last year, I made $142,000 in passive income, not from rental properties, not from dividend stocks, but from something completely different. And here's the thing, even if you have never invested beyond your retirement account, even if you think you need millions to access good investment opportunities, but what I'm about to share might surprise you. Let me start with a simple question. Have you ever noticed that when people talk about passive income, it's always about the same ideas: real estate, dividend stocks, starting a YouTube channel, affiliate marketing, creating online courses? Now, I'm not saying that these are bad, but let me tell you what nobody mentions about each one. Dividend stocks? Sure. Coca Cola pays you every quarter. But to make real money, let's say $2,000 a month, you need about $600,000 invested. And here's what they don't tell you: companies can cut their dividends anytime. Remember 2020? Hundreds of companies just stopped paying. Real estate? I have seen this up close. You're either dealing with tenants calling you at midnight about broken pipes, or you're paying a property manager 10% of your rent just to avoid the headache. Plus, you need huge down payments. The online stuff, YouTube, courses, affiliate marketing, that's not passive at all. That is just another job. Here's what I have noticed after working with hundreds of clients: every traditional passive income strategy makes you choose. Either you get predictable income but low returns, or you chase higher returns but lose sleep worrying about crashes. But what if I told you there's a way to get both? 6 months ago, I received a payment of $71,000, not from rent, not from dividends, from something most people have never heard of. Let me explain this simply. You know how when you put money in a bank, they guarantee you will get it back plus some interest? Well, imagine if instead of 2% interest, you could get 12% or 15%. And instead of your local bank, you are dealing with institutions like JP Morgan or Goldman Sachs. That's essentially what I am doing, but with a twist. It's called structure notes. Think of it like this: I make an agreement with a major bank, I give them my money for, let's say, 2 years. They promise to pay me a specific amount every 6 months. In my case, it was 12.7% annually. But here's the key part: they also promise that even if the stock market crashes up to a certain limit, I won't lose more than a certain amount. In my example, the bank said, Khalid will pay you 12.7% every year as long as the S&P 500 doesn't fall more than 40% from where it starts. Now, has S&P 500 ever fallen 40%? Very rarely. The 2008 crisis was about 50%, but that was once in a lifetime. Most market crashes are 20 to 30%. So I'm getting paid 12.7% annually while being protected from most market crashes. That's not speculation, that's a contract. I have actually included the real document for this investment in the description below so you can see exactly what I'm talking about. Now, let me be clear. Not every structure note pays 12.7%. Some pay 8%, some pay 15%. It depends on what you choose and when you invest. The point isn't the exact number, it's that you know what you are getting before you invest. Here's how I actually do this: instead of putting all my money in one investment, I spread it across different structure notes that mature at different times. Some end in 18 months, some in 3 years. This way, I'm getting regular payments, and when each one matures, I can reinvest the money. Right now, I have about $1.2 million spread across these investments. They generate roughly $142,000 per year in payments that I can count on. When each investment matures, I know exactly what happens. I get my money back and I can decide what to do next. No surprises, no wondering what went wrong. Now you might be thinking, Khalid, this sounds too good to be true. I get it. Let me tell you the real considerations. First, these aren't short term investments. Most run for 18 years to 5 years. You're not day trading here. Second, you're trusting that the bank will keep its promise. But we are talking about JP Morgan, Goldman Sachs, Citibank. If they fail, we have all the bigger problems. Third, if you need your money early, you can actually sell, but you might not get the best price. But here's what changes everything: the protection. With regular investments, if the market crashes, you lose money. With these, you can choose your protection level. Maybe you are comfortable with 10% buffer. Maybe you want 30%. You decide upfront. A buffer means your capital is fully protected as long as the market doesn't fall by more than a certain amount, say 20% or 40%, from where it was when you had started. So, if you have a 40% buffer, the market can drop 39% and you can still get your full principal back. Only if it drops more do you start to see a loss, and even then, it's defined upfront. Let me tell you about a client of mine. He's a senior executive at a big company here in Dubai. He came to me with $900,000 in mutual funds and individual stocks. Some years he made 18%, other years he lost 25%. He couldn't plan anything because he never knew what to expect. We restructured everything using structure notes. Now he gets $22,500 every quarter, like clockwork. He can plan his kids' school fees, family vacations, everything because his income is predictable. After 18 years in this business, I can tell you that's what people really want. Not necessarily higher returns, but the peace of mind that comes from knowing what to expect. Here's something interesting. If you have 5 million with a major bank, your private banker will definitely tell you about structure notes. But if you have less than that, they probably won't even mention them. Not because you can't access them, but because most advisors don't focus on them. So here's the gap where the strategies wealthy families use to generate predictable income remain unknown to most successful professionals who could actually benefit from the same approach. Now, let me be practical about this. If you're starting with, let's say, $300,000, you could spread this across several different structure notes. Conservative ones might target 8 to 10% annually with higher protection. More aggressive ones might target 12 to 15% with less protection. You choose based on what helps you sleep at night. The advantage is certainty. You are not checking your phone every morning to see if the market crashed overnight. You're not wondering if your dividend will get cut. You know what you're getting and when you're getting it. This isn't about eliminating all risk. That is impossible. It's about choosing your risk consciously and getting paid appropriately for taking them. You know what's funny? The biggest pension funds, sovereign wealth funds, insurance companies, they all use structured notes. They are not gambling with people's retirement money. They are using systematic approaches that gives predictable results. The same principle work for individual investors, just at a smaller scale. Look, if you're tired of choosing between growth and safety, if you want investment income you can actually plan around, this might be worth exploring. I help clients design these approaches through Quadra Wealth, but more importantly, I want you to know that you have options beyond the usual suspects everyone talks about. You don't have to accept unpredictable investment income. You don't have to choose between making money and sleeping well. You don't have to hope your financial plan works out. You can structure it to work. If this makes sense to you, I have a detailed video called Stop Guessing Predictable Wealth with Structure Notes. It's about 30 minutes and I walk through exactly how these work. with real examples. You will find the link below. Whenever you're ready to explore something beyond the usual investment advice, I'm here to help you understand what's possible.